There will be a day when the bond auction opens and no one shows up. No panic headline, no breaking news alert, no dramatic collapse, just silence. And when that happens, everything you think is safe stops being safe. Let's make this simple. Either the world will always fund American government debt, or the system only works until it doesn't. There is no third option. And the most dangerous belief in markets right now is that bond demand is permanent. It isn't. People think bond auctions will fail when yields spike, but they don't. They fail when confidence just disappears into thin air, when buyers stop asking, what yield do I get? And start asking something entirely different. Why am I even here? Now that shift doesn't look dramatic. It looks empty. So here's the real fear. A failed auction doesn't mean rates go up. It means price discovery just breaks. It means no clearing of price. It means there is no longer a natural buyer. And it means no market signal. And when there's no signal, the system doesn't just adjust. It has to intervene. Now, this is a discomforting cliff, a disconcerting plateau. Here's the uncomfortable truth. Bond markets don't collapse just from selling. They collapse from absence, from ambivalence, from antipathy, from indifference, from no one caring enough to bid up US debt. And if that sounds impossible, good, because there's where most people actually stop thinking. There's something very mechanical, something malevolently institutional about this, something we need to address and think about as investors, portfolio holders, traders, and just concerned citizens. So what is a bond auction? A bond auction is not a vote of confidence. It's a liquidity test. Governments don't ask the following question. Do you like my debt? No United States, no Bank of Japan, no Bank of England gilt is asking, do you like my debt, good sir? They ask, can you absorb my debt? Each auction, therefore, answers one primary question. Is there enough balance sheet capacity today to clear this supply? That's it. That's all it asks. So who actually buys the bonds? Because contrary to popular belief, bond auctions aren't dominated by pension funds, long-term prudential investors, believers in fiscal discipline. They are dominated by primary dealers, and they are dominated by intermediaries. The dealers, the banks that we love, the balance sheets that are vaunted and fortress-like. They buy not because they want the duration, but because they can temporarily warehouse it. Until, of course, they can't. So why do auctions fail? And why don't they fail that often? Because when demand weakens, three things usually happen. Yields rise, dealers step in, the central bank adjusts the conditions. So auctions don't actually fail publicly. They are rescued very, very surreptitiously and very quietly. That's why people think failure is impossible. But that confidence is built on the rules of intervention, not on strength. Because the real failure mode, what we need to really be assessing as investors, portfolio holders, and concerned citizens is the real failure isn't no bids. It's non-economic bids. When buyers show up, not because the yield compensates the risk, but because they expect the fiscal and monetary support. That's not a market, that is a placeholder. And placeholders disappear the moment confidence in backstops and intervention and the ability to print ad infinitum actually weakens. So why does this matter right now? Well, if you're following mainstream treasury news, which, let's be honest, maybe you're not, but debt issuance is exploding, guys. Not gradually, not cyclically, but structurally. Deficits are no longer counter-cyclical. They are now permanent. They're there forever. De facto, de jure, they're not going away. Which means auctions are no longer occasional tests. They are constant stress test events. The system has to clear more and more debt, more and more often, with less and less margin for any type of error. And this is why the role of the central bank is becoming incestually interwoven and intertwined. This is where most people misunderstand the intervention. Central banks don't step in because auctions fell. They step in to prevent the signal of failure. Because once an auction visibly fails in the brutal light of day, currency confidence breaks, collateral values wobble, repo markets destabilize completely, risk reprices absolutely everywhere. So the goal is silence. It's not stability, it's getting away with the ruse. So what does a failed auction actually trigger? Well, mayhem obviously, but no, more soberly, if an auction truly fails, meaning no clearing without coercion, the chain reaction is going to be apocalyptic. It's going to be mechanical. Emergency liquidity facilities are going to start up. Balance sheet expansions will be inevitable. Forced buyers are going to be there. Yield suppression, currency pressure, none of this is optional. This is the unwritten rule. It's the mandatory agreement between the primary dealers and all of those in bed with the Federal Reserve and every other central bank around the world. It's the unwritten covenant. Because sovereign debt is the foundational layer in our entire financial system. But there's a reason why this is dangerous. There's a reason why you won't see this coming. Here's the part that matters for me, for you, our portfolios, and for our markets. You will not see bond auction failure on a headline. You'll see strong demand from indirect bidders, technical adjustments, pre-facility usage, or some other acronym that we have no idea what it means in its inscrutability and its esotericism. Orderly conditions must be restored. Yes, the language will be calm, but the intervention will be absolutely unfathomably massive. And this brings us full circle again. Because when auctions strain, liquidity doesn't just disappear, it is forced into existence. Which is why bond stress often leads to equity rallies, volatility suppression, asset inflation. Not because things are healthy, it's never because things are healthy, but because the system cannot tolerate a visible crack. And then the liquidity comes back in full force. Bond auctions don't fail loudly. They go out with a whimper. They fail quietly. And when they do, the response is never ever austerity. It's always liquidity. And that's what matters for our portfolios. So in the next video, we're going to look at who is being forced to absorb this debt, why it's becoming unsustainable, and what breaks after confidence. Not prices, but confidence finally cracks. Because when no one shows up, the system always shows up. Okay, so tune in for the next video. Ciao for now. This is the House of Trade.